Thank you to be here for this conference that is going to deal with a subject that it's very fashion today. It's important to speak about carbon footprint, but it's not so banal and so easy. I'm very proud to have with me my colleague in this panel that I'm going to introduce in few minutes because my pleasure is to give the speech to Guido Gese. It's not your first time with us, and it's always a pleasure to hear your presentation and your research and analysis that will bring us in understanding what really could mean carbon footprint at portfolio level, and it's not so immediate, it's not so easy as probably at the first step you can imagine. Okay, let's do some claps for introducing the presentation. And Guido, the stage is for you now.
Can you switch on the microphone? Yeah. Yes. Yeah. Can you hear me? Yeah. Thank you for the introduction. And the slides are on, yes. So my name is Guido Gese. I'm heading MSCI's ESG and climate...
You can see your slide there.
Yeah. If you need. Yes, there. So I'm heading MSCI's ESG and climate solutions research team in London. And I would like to give you a brief overview of the challenges that we've seen with clients when it comes to using climate metrics and tracking the footprint of a portfolio, the carbon footprint of a portfolio. And to be precise, I would like to start with 4 really typical investor questions that I heard many, many times over the past years. The first question is, why are there suddenly so many climate metrics? Because 5 years ago, there was only scope 1 and 2 emissions, and suddenly there's a universe of climate metrics, ITR and stress testing and all sorts of things. And people ask, what's the point of all that stuff? It's a jungle. Why do we need this? Shall I use that? Where do I use it? The second question that I often got, what about this forward-looking climate metrics versus backward-looking? What does it mean, and where do I use what? And isn't forward-looking always better than backward-looking? Maybe I just use forward-looking. So these are the second question I get very often. The third question I often get is, how do I choose the right, in quotation mark, climate metrics for me to track the footprint of my portfolio? So how do I decide which climate metrics I'm going to use? And the fourth question is, how do I attribute changes over time? Because all these climate metrics, they're very volatile. How do I understand the drivers of changes in the carbon footprint? And that turns out to be quite complicated, as Luca already alluded to. But let's start with the first question. Why are there so many climate metrics? We developed a lot of new climate metrics in the last years following TCFD recommendations. And at the first glance, you might say this is a jungle. But we don't want it to be a jungle. And that's why at MSCI we decided, let's create a decision tree. And the decision tree helps you to find what question each climate metrics answers. And the decision tree works like this. At the top, you have the box saying, we want to measure climate. And then the tree branches into 2 subtrees. On the left-hand side, we are measuring climate impact. So the impact companies have on heating up the atmosphere. So everything on the left-hand side is driving temperature. It's measured in temperature or driving temperature. Everything on the right-hand side is measuring risk. So the impact of climate change on companies. So everything on the right-hand side is measured in dollars, in euros or pounds. And then both of these subtrees, they sub-branch into 2 subtrees. One part measures the current situation, so your current impact or your current risk exposure. And then the second subtree measures the projected future, because climate is something that will most likely last several decades, so we're doing projections into the future. So this is why we have these 4 subtrees. And if you go from left to right, you see measuring the current impact of companies. We're looking at scope 1, 2 emissions, plus the scope 3 emissions to measure the supply chain effect. Projected future income. Here we have the potential emission from fossil fuel reserves And we have implied temperature rise. Implied temperature rise is a projection of the total carbon footprint a company may have 30, 40 years into the future. So everything that we will think the company will emit. Then going to the right-hand side of the tree, risk. Here again, we have the current risk situation, which we measure with the current carbon intensity or the current exposure to green revenues. And then we're doing stress testing to make projections into the future. So how could this company perform if there's a carbon price shock, a policy shock? So this is basically the tree: risk and impact, current situation, future situation. Now the practical question you might ask, is that stuff really necessary? Isn't that stuff just all highly correlated? Isn't it just 95% correlated and I only need one of those indicators? No, it isn't. So we did the correlation analysis. So this is the correlation matrix in MSCI Acqui, so 9,000 shares globally, and we did the average correlation between all these climate metrics. Don't worry, I'm not going to take you through all the numbers. I tell you the summary. These are not so highly correlated. The reason is that these measures actually measure something different. So each of these measures gives you a different aspect of climate impact, climate risk, current situation, future situations. If you want to know more about why it's so different, we have a research paper just going into the differences. But just as a summary, these things measure a different thing. Now, the second question I want to address, what about this forward-looking, backward-looking? There are very strong opinions in the market. I heard clients saying, forward-looking is smarter. I'm only using forward-looking metrics. Then other people say, I don't trust forward-looking because this is all kind of projected. I'm only using backward-looking. The key question here is, can you combine it in a smart way? Yes, you can, and that's actually the smartest thing, because let's do a thought experiment. Let's say you have a target pathway for your portfolio. So you want to decarbonize your portfolio, given us a green pathway. I made it green here. And let's assume you're only using backward-looking data. That's the left chart. If you're only using backward-looking data, it's like driving a car just looking in the rearview mirror. You will always see backward-looking when your portfolio is off track, and you will have to make huge corrections because you're only backward-looking. So you will zigzag very ineffectively around your target lane. Let's do the second thought experiment. Let's say you're only using forward-looking metrics, target data, or ITR. The problem with this forward-looking data is it's not perfectly predictive. It doesn't really predict the future. It's just a projection in which directions company might go. So if you only rely on target data, you're very likely to drift off reality with your portfolio because many companies will miss their targets. Sorry, I'm a pessimist, but no, I'm not a pessimist, I'm a realist. So you might drift away from reality. So the smartest way is to combine forward-looking and backward-looking in portfolio construction so that you use forward-looking metrics to guide your decisions and backward-looking data to see, did companies achieve their targets? If yes, that's fine. If they didn't, well, then you need to react to it, right? So the combination is crucial to smoothen out your pathway. So that's the second question. The third question is, if I want to track the carbon footprint of my portfolio, kind of the backward-looking side, how do I do that? And here we see there are different climate metrics that are proposed by TCFD and GFANS and so on. The first one is to use financed emissions, which is an absolute measure. It measures the tons I'm owning, the tons of emissions I'm owning in my portfolio. It's not size adjusted. And then there are two size adjusted footprint measures, which is the finance emission intensity, which is basically the weighted company emissions over EVIC. And then there's also the weighted company emissions over sales. Both of them are used by different clients and different asset owners. The question is, how do you decide whether you want to use financed emissions or intensity, for example? Intensities are size adjusted. Well, the thing is, depends on your use case. So let's assume you're tracking your portfolio in terms of financed emissions on the left-hand side. Financed emission is an absolute measure, which means whenever there's an inflow in your portfolio, your footprint goes up because you're financing more. Whenever there's an outflow from a portfolio, your footprint goes down because you're financing less. That's a challenge because if you have targets and you want to follow targets and you have inflows and outflows, you will always need to explain why you're missing a target, right? but you had an inflow. That's fair, right? But still, it's difficult. That's why we see that finance emissions are typically used by very large asset owners that have very stable portfolios, because then inflows, outflows are not so big compared to the size. However, if you're a portfolio manager with a lot of trading activities, so there's a lot of inflows, outflows, typically we see portfolio managers go for a size-adjusted measure, so finance emission intensity or the WACC, so emissions over sales. So both are used by the market, emissions over EVIC or emissions over sales. But then you get into another problem, which you see on the right-hand side, because you have a lot of market moves in there. The EVICs change, or the sales change, or the weights shift, and you get these pretty nasty fluctuations which make it very hard to track the footprint of a portfolio. But either way, whether you use the finance emissions or finance emission intensities, you will ultimately need a tool that explains what has caused the change in my portfolio, the footprint change. So what drives the change in emissions? And this is what we have developed at MSCI, and it's a new tool that we're rolling out in December this year. And it works like this, and I have to apologize to show a formula today, but it's still before lunch. I wouldn't do that after lunch, after you had a wine, but before lunch you had a coffee, so I hope it's fine to show a formula here. So this is just, this is the finance emission intensity, and what it basically is, you're summing your portfolio has weights, and you're summing basically the weighted greenhouse gas emissions of the companies divided by the EVICs, the enterprise values including cash. Or you can use sales as well, right? Intensity works with both, with sales or with EVICs. But then you can already see this thing can change for all sorts of reasons. It can change because the portfolio manager is adding or divesting securities. It can change because the weights shift, right? There's market fluctuations in weights. And it can change because the emissions change, the company's emissions change, or companies' EVICs change, or their sales change. So there are all sorts of influences that can influence the footprint. And to disentangle the different drivers, what we did is we said, we built an attribution framework that attributes changes in 3 layers. Layer number 1, the changes in the universe by the portfolio manager. So the portfolio manager bought or divested securities. That's layer number 1. Layer number 2, shifts in weights of the portfolio, shifts in weights. And layer number 3 is the actual emission intensity of the individual companies changing. So we have 3 layers, and basically how the report looks that we are launching now as a reporting tool is like this. This is a real-world example. I know it looks complicated as a first glance, but it's actually not so complicated. This is a real-world emission change of MSCI ACWI IMI, so 9,000 global companies covering developed and emerging markets, and it's the emission intensity change from April 2021 till April 2022. And what you see, the top level, you see the emission intensity of the global market, 9,000 shares, has decreased by 2.3%, 2.3% decline. But then you ask yourself, where did that come from? Then we go layer number 1. The benchmark, our global benchmark, rebalances twice a year. So stuff goes in, stuff goes out. Now in that year, MSCI kicked out Russia and Argentina from the global benchmark. Well, that has helped carbon intensity because Russia and Argentina are very carbon intense. So because of that, the carbon intensity declined by 3.6%. But that is not a real-world effect because Russia is still out there polluting. It's just no longer in the benchmark, right? So that declines the carbon intensity by 3.6%, but it didn't make the world any greener, right? It made the benchmark greener. Then you look at the existing benchmark. The existing positions increased by 0.4%, but then you drill down what has happened there. You see a lot of things happened. In that year, the energy sector had a huge rebound, right? The energy stocks rebounded, their share price went up, their weight increased. And because their weight increased, the carbon intensity increased by 15.8%. Again, this is not a real-world effect because the emission intensity of the energy sector is there. It's just their weight increased. It's a technical effect in the footprint. And then there's another technical effect, which is the growth of EVIX. So the enterprise values grew by 11%, and that pushed down the intensities by 11%. A lot of technicalities going on, and then you ask yourself, what is the real-world effect? That is 6.6%. So the real-world emission reduction in that year from acqui companies were 6.6%. Now that sounds fantastic. The real-world decline was 6.6%. Unfortunately, don't open the champagne bottles yet, because this is the COVID dip. A year later, the black box is up 6%. Unfortunately, no good news. It's just the COVID dip. But what you can see is the headline carbon footprint is a different number than the real-world effect. And what we see in the market, the big shift in the market is 3 years ago, all our clients looked at the top-level number. Today, everybody asks us about the real-world effect. What's the real-world effect? And we even have clients saying they want to set targets on the real-world effect number. They want to influence the real-world number by voting engagement or stock selection, selecting those companies that self-decarbonize. So the entire discussion of carbon footprinting in the last 3 years shifted from the top-level number to the lower number. And this is why we launched this carbon footprint tool. So this tool that allows you to attribute changes going live in December for finance emissions and intensities. The funny thing is, the tree for finance emissions and intensities looks completely different because the technical effects are different, but the black box is the same. So if you measure the real-world effect, it does not matter whether you use finance emissions, emissions over EVIC, or emissions over sales. The black box is always the same. All the other things is technicalities. So this is basically the challenge of tracking carbon footprint. It is not so easy, as you see. You need a bit of math. But we have this footprinting tool that allows you to disentangle these effects. And by the way, the color code of the boxes is important. The blue boxes is what the portfolio manager can influence. The black box is the real-world effect, and the turquoise box is the financial data from companies. So you're really disentangling what the portfolio manager can influence and the other effects. This is pretty much the overview. If you have more, if you want to take a deep dive, we published the methodology for attribution in the Journal of Portfolio Management. So if you want to go through the math, how this attribution works, it's in an academic journal. And if you want to go into this difference of climate metrics measuring impact versus measuring risk, we explain that in a research insight, Understanding MSCI's Climate Metrics. It's also on our website. So just in case you want to take a deep dive into the formulas, into the math. So with that, I want to finish the overview of the challenges, and I think now we can start an interesting discussion, I hope.
Okay, Guido, thank you very much. The book is just before lunch, because I suppose that it's quite complicated now. I'm joking. Thank you for making us understandable these complex topics. And I start looking at the black box in my future, and I'm wondering to myself, it's real that number, or there is technical mathematics on so on that is changing the effect real world of the carbon footprint. Okay, let's open the discussion with our panelists, and thank you for being with us. Sorry that Okay, from my right, Belinda Gunn, ESG Investment Director of the Capital Group. Thank you for being here. Ophélie Mortier, Chief Sustainability Investment Officer, DIPAM, and Diego Del Genio, Head Global ESG Integrated, the Swiss Canton. Okay, welcome to our discussion. And please, Guido, feel free to remark if you see something that could be underlined. Okay, we start with Diego on my left, and following our short discussion before the round table, your aim is to describe in which way Swiss Canton approach
Of course.
Okay.
Of course. Maybe just as a short introduction, the topic of carbon, carbon footprint in general and climate risk is extremely important at Swisscanto. Back in 2020, we really roll out a climate policy basically for all our investment funds. That means in any single years we reduce the carbon intensity in our portfolio. And we have set out relative ambition target in 2020. So the idea is to reduce cumulative around 70% of the carbon emission in our portfolios by 2050. So to put into another perspective, basically we are completely aligned with the Paris Climate Agreement of 2015. Okay. And to answer your question, Luca, what is the approach that we are following? We are really focusing on the carbon intensity metrics. To reference the Guido presentation, we are using the formula that Guido showed us, but we are adjusting this for the revenue. So we are basically looking at the single company emission in metric tons per unit of revenue. And the reason why we are focusing on this metric is not because Guido mentioned this metric is very interesting if you have a lot of flows, for example, can be very helpful. But the reason why we are using this is much more because of comparability. We are using into our stock selection process, and that means we want to be able to compare this metric across stocks in our daily stock selection process. We want to be able to compare in the portfolio that we are running, and of course to be able to have a reference versus the underlying benchmark. So, and this metric does really a good job here. Of course, to a certain extent, we also mentioned, metrics are never perfect, so we also expect, there is no perfect comparability, but overall, the metric does really a good job of achieving our objective. And our objective is really about, bringing down the carbon footprint in your portfolio. This is the priority number one, but also to have a flexible investment framework where you can use this data in combination with other variables, right? So not only carbon intensity, but also financial score and so on. This is for us extremely important.
Just a very quick question. Are your clients ready to understand this kind of, how can I say, metrics,
I see the point.
application of the metrics?
I see the point. Really, clients' top priority number one today is disclosure. So they are also, they need to be educated in this process, right? But the number one priority today is really understanding the underlying driver of carbon footprint. And this brings me maybe to one very important point. One of the benefits of this metric is that allow you really good disclosure. So we can offer client a good disclosure, so we can show how does the carbon footprint look like, and we can compare to the benchmark. We have seen from Guido presentation, finance emissions are not really good if you want to do this disclosure, right? You cannot really compare by using finance emission your portfolio. There is no size element in it, so you need to use one measure where you have this sizing component, and that's why actually this is probably the second reason why we are using this metric, because we can use in our process and we can offer clients a picture of the carbon footprint in the portfolio.
Well, Ophélie, let's introduce another item on the discussion. The word is scientific.
Yes.
How is
great.
important, which is the importance of the scientific data?
Yes, so as an active sustainable research asset manager for more than 20 years in sustainable investments, for us, as Guido said, it's very important to have the combination of a backward-looking and a forward-looking approach, because the carbon footprint is important information, but we have to know what is behind this carbon footprint, and we need as well a view on the future development, because what we are looking for is sustainable growth, meaning that we look at the sustainable future of the companies we invest in, meaning that we have also a global view on the climate risk we take at DPAM level, meaning that we look at different metrics, and that's also a key recommendations for us, is to use not one single metric, because it reduces the risk to one single view, but it's very important to have different metrics accompanied by a qualitative and fundamental research to understand what are behind the figures. So to be very concrete, what we have developed for more than 5 years now, for all our portfolios, whatever the SFDR typology or the level of sustainability, we look at the 5 most contributors to the carbon footprint of the portfolio. And we do for all those issuers a very in-depth fundamental analysis according to the template of the TCFD recommendations. And so in that case, we know exactly what are the current risks, and we look also to the transition, whether they are on track regarding the transitions, because we will look at indicators like the fossil fuels exposure, the mining exposures, the greenhouse gas intensity, the water indicators. So it's a combination of several indicators to understand what is behind some metrics, based also with forward-looking data. And related to science-based target initiatives, that's an initiative we have joined when we decided to join the Net Zero Asset Management Initiative. The commitment of DPAM was firstly based on a feasibility study. And we do not think that looking only, as Guido said, only backward looking would be a right approach. That's why for the Net Zero Asset Management Initiatives, we go for the science-based target initiatives, because also it is a lot based on engagement, and we are a strong believer that engagement make an impact. And for example, with all the analysis we have on this TCFD very detailed frameworks, we have now more than 5-year track record, and we have also linked this with the climate accountability, meaning that when we vote, when we engage, even if there is no topic, and this is regularly the case, you have no topic on environmental issues or something like this on the agenda of the general shareholders meetings. But anyway, we have different tools to be aligned with our convictions regarding what we have analyzed on the risk issue. So for me, it's really a combination of backward, forward-looking, to have the proof that they are doing what they do, but also to look at the future, because we are looking for sustainable growth, meaning as well that we are a medium long-term investors. We do not do a lot of trades. Generally, we invest for the long term with the companies and the countries as well.
Thank you, Feline. Now, Belinda, sorry if I leave you on my shoulder in some moments. Let's talk about carbon footprint tailor-made. I mean, in which way you answer to the different requirements of your clients. Sorry.
Thank you, Luca, and hi everyone. It's great to be here. Just by way of background on Capital Group, because it'll frame my response. So we're one of the oldest and largest active management companies in the world. Today we manage over $2.3 trillion across equity, fixed income, and multi-asset. And our approach is very much grounded in deep, bottom-up fundamental research. So as part of my role as an investment director, I work with our clients to help them understand how we approach ESG, including climate analysis, but also specifically with them on their own ESG objectives, any climate objectives that they've set. So my answer will come at that from the 2 different perspectives. So firstly, in terms of how we think about carbon and understanding overall climate risk in our portfolios, we're focused, as I mentioned, so on bottom-up analysis rather than the high-level portfolio measures. As everyone, I think, has said, there isn't one single perfect metric, and so it's a variety of metrics that we use, both backwards-looking and forwards-looking. But the starting point for us is really identifying which of the sectors do we think are most likely going to be impacted materially by climate change. We've developed over 30 sector-specific frameworks, and in roughly 3/4 of those, so over 20 of those investment frameworks, climate change and climate risk is identified as material. So within that, we then look at best practice, some of the metrics that we can measure, and actually we have more than 40 different climate-related metrics that we're bringing in, including some of the ones that I mentioned, but also some others, to really help inform our bottom-up company-level analysis. So we look at things like I've been mentioned, so the historical emissions, emissions intensity, but we're always focused also on the forward-looking. So what are companies' commitments? What are their targets? What is the strategy, implementation? Where are they spending their money? And is that in line with sort of the targets and commitments that they've made? We also think about, are they using an internal carbon price themselves? Are the companies doing their own climate scenario modelling? Because that's all helpful information for us as we assess each of those companies. And importantly, because all the data doesn't provide the answers, we engage, as some of our others have mentioned, with companies to really understand their plans, fill in some of the data gaps, and also understand, get some additional insights into their strategy and plans for implementation. If I then change and then focus on our clients, which are across Europe and Asia, they of course have unique circumstances, different objectives, points of views, different time horizons, and of course implementation preferences, which will all impact sort of how they approach climate in their portfolios. They are at very different stages of the journey. I think we've seen the whole spectrum. Some are very advanced in their thinking. They've made commitments. They have a very clear view of what they want measured, what they want reported, and the expectation of how that changes over time. On the other end of the spectrum, though, we have some clients who still are at very early stages of exploring climate and carbon in their portfolios, but they're keen to learn more, understand. I think if we threw all of those metrics that we had, Guido, at them, I think they might run away straight away. But it's sort of starting very early, engaging, having that conversation, and then as their understanding grows, building some more of that knowledge. But despite all the differences our clients have, in general, we see a focus and lots of questions on portfolio WACI, the weighted average carbon intensity. But increasingly, we're seeing more focused on the finance emissions and the sort of focus on that sort of PCAF methodology that's coming through. So we've seen some of the changes, but a wide spectrum across Europe and Asia, as you can imagine.
Do you want to remark something about the first round of discussion, or we wait for the second?
Yeah, no, I think just one point that Belinda has just mentioned. I think there has been a shift in what metrics investors use, and we've seen the same. We've seen that more and more investors try to align with the PCAF methodology, and it's also recommended by GFANs. And I think the reason why that shift has happened, for example, 5 years ago, the majority of Msci clients have been using emissions over revenues or sales, for example, which is still a good metrics. I think the reason why we've seen a shift proposed by GFANs, for example, also by PCAF, to use emissions over EVIC is that emissions over EVIC is, technically speaking, more aligned with measuring impact. Because when you look at the formula, so weighted emissions, sorry for going to formulas, weighted emissions over EVIC, mathematically speaking, it's the same as taking finest emissions divided by portfolio size. So basically, the EVIC one measures the impact you're financing per dollar invested. It's more of an impact view, while the view emissions over sales is, for me, more a risk view. It basically says how risky are the business models of companies doing those emissions. And this is why we've seen that shift from PCAF and GFANs, because they want investors to focus more on the impact side of the tree, basically. That's the comment I want to make, yeah.
Okay, thank you for remarking this aspect. I think I feel it's important. Okay, let's go with the second round. Diego, your colleagues already mentioned the equilibrium, the balance between the backward and forward-looking approach, which is the situation for fiscal.
Before I would just add a comment on Guido. Absolutely agree on this. So it's really different perspective, and this again shows how it's important, your perspective, right? And the reason why I think it's still valid to have the approach based on revenue is really because we really matters about risk. So in any sector, if you would use this metric, you would immediately spot out companies where the carbon risk is highest. And that's why, from an asset owner perspective, client, they want to have a disclosure, but from an asset management point of view that is running asset portfolio for the clients, fiduciary risk and so on, it's really important to understand clients' risk. And that's why I think I think this is really the challenge of combining both elements. Now, coming to your point, Luca, I think ultimately, and this is also visible perfectly in your analysis, Guido, what will drive the carbon footprint of your portfolio is not really the sizing of the single holding portfolio, with the 5 to 6 year holding period, but it's really going to be company shifting business model, company embracing new technology. So for me, key and what we are doing as Riscanto, the forward-looking part is really understanding product, services, and new investment, and now those are changing or mitigating the carbon risk of the company. This is really where we spend a lot of time. Otherwise, the single metric of intensity, it is very much a price to book value, price to earning, very static, have no idea about the future. But if you combine with those understanding, then you can really balance and then you can build up a portfolio that take into account the future. And this is where our efforts are really focusing. Yeah, that's it.
Okay, thank you. Hopefully, the key word now is, client, oh sorry, not key word, is to guide the clients. In which way your colleague already mentioned the necessity to be case by case. What's happening in Deepan from this point of view?
I agree with Belinda. We have different levels. I would say our clients are at different levels in their sustainable journey. So we could have already very major, big pension funds committed to sustainable investments for several years. So where the questions can be very challenging regarding the details and what about their carbon footprint, and they will have also their own targets regarding climate in terms of reportings, in terms of their voting policy, what they want us to implement. And for others, it still they are starting the journey, so they are looking what are the different options. So as Belinda says, I think that's the role why as we mentioned, we are a sustainable actor, investor, and partner, and the partner means accompanying and educating our clients. So we share a lot of information regarding the climate risk. We have reported for the last 5 years on our TCFD recommendations, because I think it remains a very good framework for climate risk. Notably also, but I think we will discuss that a bit later, notably because they also introduced the notion of scenario, which is something quite challenging, but normally in the financial world we are quite used to work with scenario analysis. So it's also important to explain to the clients, okay, and the scientific world is very clear on that. We know that the next decade will be very crucial for the rest of the evolutions of the climate change. So it's important to be super clear in terms of scenario, because the longer we wait, the more difficult it will be. And that's also the reason why we worked with different scenarios that we explain to our clients to guide them about the differences of transition, physical risk, and what could be the impact on their portfolio if we go in rather one action or under the other options in terms of climate change mitigation and adaptation.
Very well. Okay, Belinda, I turn myself to you now again, and a technical question. You suggest to speak about WACI. Sorry, I don't know if it's correct, my pronunciation in English, Italian, but you understand. And why you use it and in which way?
Sure. So we use WACI. So a reminder, the weighted average carbon intensity, it's the metric that's recommended by TCFD. We're a supporter of TCFD, so we report along those lines. In our TCFD reporting, we show the WACI for our total listed equity investments. We do the same for all of our corporate bond, the debt side as well. And then we also just provide visibility on what the WACI looks like for our top 5 largest funds by assets under management. The second way which we use it is we provide, I mentioned earlier that some clients are focused, at least those dipping their toe in, as a starting point, they are looking at, well, what is the portfolio WACI versus a reference index? So we provide that in our client reporting. So it's a starting point for a discussion. It's not going to give them all the answers. I think Guido's gone through lots of complexities, but it's a starting point to help them, and then it's really educating them on what does that actually mean from that perspective. And then the third way that which we use WACI is for some of our funds that we offer to our clients, we have a specific explicit carbon target to have a WACI that is 30% below the reference index. So, you know, in our reporting at the firm-wide level, reporting from a client perspective, and then also in a way in which we offer certain types of products for our clients and funds, if that's something that they're choosing, given the objectives that they have. But if I may, I'd like to highlight just some considerations around WACI, because we've had some really interesting discussions internally, and this is part of the client education journey. We obviously know it's backwards looking, it's a point in time based, we've discussed that, but maybe just to highlight that the data is often at a 2-year lag. So for most of the carbon intensity data you have today, that's based on sort of, you know, it's FY21 data for the majority of companies, so there's a reasonable lag there. Scope 3 emissions are not captured. And I think importantly, it can be a volatile metric. So what do I mean by that? There can be large swings year on year in WACI, and that could be changes to the numerator, so the absolute emissions, or indeed the revenues, the denominator. So just to give you an example, we were looking internally at a large US oil company, and its absolute emissions decreased 5% between 2019 and 2020, but its carbon intensity increased 36%. Then, if you go forward a couple of years and look between 2020 and 2022, absolute emissions stayed flat. But the carbon intensity decreased by 55%. So before it increased 36%, then it's decreased 55%. So you can see that it's a volatile metric, and you have to be careful in terms of how you use that metric as an indicator of exposure to climate risk or a measure of the company's climate performance, so to speak. Another example, I'll just give you one more, is a European oil and gas company that has consistently decreased its absolute emissions, so scope 1 and 2 emissions, since 2008. But their carbon intensity has varied drastically year on year. If you look at the chart, it goes like this. And that's based on changes in its annual reported revenue. So just 2 company examples, but you can imagine how much nuance there is. When you look at the total portfolio WACI, you really need to understand and drill down, as we sort of gone through, into individual companies and understand why that's changed, and to not make any immediate, decisions, maybe to sell or to do something drastic based on that, because it can move year on year. So looking at that overall trajectory is what's most important to us, and doing that company by company level analysis.
Thank you, Belinda. Guido, do you know WACI?
Yeah, no, just to the point, I fully agree. I mean, this is exactly why we created the reporting tool that I showed you. And I forgot to mention that the tree that we run will not only disentangle like revenue or EVIC effect from emissions. In the report, we also have a drill down in each box, for example, to your point that some companies have extreme moves in some measures because their EVIC or their sales went down. So in our report for each box, we will have the largest contributor. So you could even see, oh, I see a huge move in intensities in existing positions. What are the 5 largest movers in that box? So we will deliver that transparency for exactly that reason.
Maybe if I... Yeah. And one thing as well, because what we highlight is understanding the metrics and the figures. But it's also important, for example, regarding the SBTi or the engagement regarding transition and so on. It's important to understand how the company will realize their reduction of carbon footprint or the climate targets they have defined, because it can be done by a more efficient production system, but it can be also done by new investments in new technologies. It can be done by selling some very polluting activities. And that's also, it's very important when you engage with the company on their targets. It's not just looking at what they are committed, whether it is ambition or not. secondly, whether they will realize it or not, but also to understand how they will realize it, because it's also important regarding the financial health of the business to understand how they will do this. So again, I think it's very important to have all the time a fundamental research next to the metrics, and if possible, with the involvement of the analysts and the portfolio managers, and not only the specialists on sustainability and so on, because it's important that everybody understand the different elements of the ecosystem. Thank you.
Okay, thank you. I would like to put on the table a quick question for every one of you. And let's stay on the clients. So, the two questions are, when the world has changed? I mean, when your clients started to ask you about disclosure, about education, about leading, and about formula also, if I'm referring to the formula you showed before. And the second is when this starting the journey that all of you mentioned in your answers will become the journey. Next year, 2 years, 10 years, never. Okay, we start with
an interesting point, because I've been, and we were discussing with Guido over the coffee. The first time that I experienced this trend was in 2005 when Bush did the speech on the renewables. So probably in the past we have seen already this event, but they were very much regional. So what we are experiencing today is really a global event of a huge magnitude, and this is really the first time where we have across different regions strong momentum, both political momentum, corporate momentum, and asset owner momentum behind the topic of sustainability and / climate. So I think this is the first time. In this form, I would say probably around 2020 was really the first time where you have a big combination of several drivers. COVID played a very important role. The EU put a lot of money on the table, and so the topic of decarbonization is not simply an investment topic, but it's about energy security. So I think this is also the rationale why we have seen 2020 a massive increase in momentum behind it.
Ophélie?
I tend to agree. I think that for several big institutional players, it was already the case before, with stronger commitment already in 2005, 2006, when we spoke already about the concept of stranded assets. But clearly with the different COP, with the Paris Agreement and the SFDR, which is important in terms of disclosure, but another key element of SFDR next to the disclosure and the typology of the products is the obligation, and that was a main objective of the European Commission, is to report and to monitor the sustainability risks. So you have to define, you have to show how you measure it, how you manage it, and clearly within the sustainability risk, of course, climate change is not the only one. The social and the governance are also very important. It has been always the case at DPAM, but it's also an important part of the sustainability risk. So you see as well a second group joining for this aspect of materiality, which they consider very important as well.
We know the question is also for you.
Yes.
When the world changed.
Yeah, no, thank you. No, I agree with what Diego said. I think we today are in a situation where climate investing and sustainability investing has become a global trend. I mean, 5 years ago, 10 years ago, and we were both at Robeco 10 years ago, it was really a European topic. And today it's a global topic. The interesting thing is, but there is a regional difference in the key motivation. When we talk to European investors, we still feel that a key motivation for European investors is to drive real-world impact. We want to be part of the solution. We want to drive the real economy towards net zero. In the US, it's different. So we know in the US there is some political debates, we know that. But despite that, political disturbances over there, we have a lot of interest from US clients, but their interest is not in driving real-world impact. Their interest is in making money by investing in new technologies. So when we look at what our American clients ask for, it's mainly about where are the opportunities, where's the green chocolate opportunities, can we use MSCI's data to make smarter investment decisions? And the funny thing is, despite the political landscape, and we know there are some states, taxes and so on, and so funny enough, we do have conversations with asset owners in Texas who said, look, we want to make money. We want to see where are green opportunities. But so it is a global trend, but the key motivations behind the trends might be a little bit different on this side of the ocean compared to the other side of the ocean.
Thank you, Guido. Belinda, so when people start to understand the formula?
I agree with Guido, definitely a global trend, but clients coming at it from a very different perspective. I think key to your question, it's a journey, not a destination, so I think it will continue. Regulation, we're seeing new regulation pop up in different parts of the world. Of course, Europe led with different regulation, but seeing things in Asia, in the UK, making pension funds having to disclose, report on certain climate aspects. So I think that will continue around the world, and we'll see more of that. If we reflect back maybe 5 or 10 years ago, think about how much climate data and corporate disclosure was available. It wasn't great. And then look at all the information that we have today. I suspect we'll continue to have new data, more disclosures, more modeling, which will mean that'll be a continual journey of understanding, clients, they may learn. I think, what I've at least observed over several years is they start with their ambitions, their climate goals, ESG goals more broadly. They don't necessarily know what impact that's going to have on their investment objectives, on their mandates. And it could be very different for a US high yield portfolio versus a European equity portfolio, like very, very different outcomes. So they set these goals, they then implement them, get the manager to implement them. Then they need to understand, well, what have I done in terms of it looks great when energy, if we exclude it, it was underperforming, great. But when suddenly energy picks up, they go, oh, I didn't quite expect that. I need to maybe revisit and rethink about things. So I think it will be this continual adjustment as they learn. I've seen, different clients start with great ambitions, realize they still need to deliver a return to their pension fund holders at the end of the day, maybe adjust, maybe not be so exclusionary, become more supportive of engagement and with companies instead of holding them. So I think lots of different approaches, and it's going to continue, but safe to say that I don't think it'll go away anytime soon.
Thank you, Belinda. So, Guido, do you want to put the hand at the lesson? You start and you hand this lesson. You want to make the final remark? I surprise you.
Yeah, that was a surprise. But yeah, no, I think as a final remark, I think the key message probably is, as you said, I think climate investing is a journey. And I think we are clearly more advanced compared to where we were 10 years ago. 10 years ago, we were struggling to find scope 1 emission data. It was really difficult. And everybody was saying, look, the data is crap and you only had 10% coverage. But look where we are today, right? And we are where we are today because we kept pushing, right? Everybody kept pushing. Asset owners asked for data, asset managers asked for data, index providers, data providers started collecting data. And so I think there's an immense progress compared to where we were 10 years ago. But we are still not where we want to be. Not in terms of emissions, because emissions haven't really come down, but also in terms of investment solutions. What I hear from clients, and I think this is the homework that we're working on, is we need to go into the implementation phase of climate, right? We have all these carbon emissions and we have targets. Fantastic that companies have targets, but now it gets into the nitty-gritty details. How do we build portfolios that finance a transition? And the data that clients are asking us about, and this is really new, this is coming from the last 1 or 2 years, is what Diego mentioned. Now they're asking us, okay, but who is spending their capex according to their targets? Who is building up technology exposure? Which automobile company is building up technology exposure to electric vehicles, to battery power? Which companies are moving? Who is investing where? So the capex data, the real world data, and this is the key, I would say, the next step of the journey, moving beyond just looking at targets, seeing, okay, but are companies investing according to that target? And this is, I would say, the next challenge for the next 5 years.
Very well. So I met you when you wrote the historical report that was fundamental of ESG rating. Now we have really a very, very huge journey in front of us. Okay, thank you to Belinda, to Guido, Feli, Diego. It was a very intense discussion. I mentioned it like a lesson. I think that it could be called like a lesson. And thank you for hearing and to be here with us. The lesson will be found also on the internet site, so it would be possible to repeat and to listen it again. Thank you very much.